Free yourself from the IRA 401k tax trap. There was a front page story on Time magazine that said why it's time to retire the 401k and do something better instead. People are not in lower tax brackets when they retire unless they didn't save very much. The more that you save and defer, the more they get on the back end. They're using you as their savings bond. It's the best savings bond they ever came up with for themselves. I'm going to show you that the most common way Americans save is the worst way, and that the premise that you will likely be in a lower tax bracket when you retire is absolutely no longer true nor axiomatic. Get ready. So I'm Doug Andrew. I've been a financial strategist and a retirement planning specialist now for 5 decades, helping retirees reposition assets so that they will not outlive their money. And the number one danger that causes most retirees to outlive their money is taxes, okay? And so many times when Americans, I think, are duped into putting money into tax-deferred IRAs and 401ks, they're told, oh, you'll likely be in a lower tax bracket when you retire. But see, that has not really been true for savers now for over 30 years, and yet Americans still, 91% of Americans, continue to follow the herd and put their money in tax-deferred IRAs and 401ks. It's like they're like this ostrich with his head in the sand and is open season with the IRS. And they just sort of are oblivious. They follow the herd. Everybody has a 401k, and they don't even take time to study what is far better, okay? So I have a little ditty I've used for years: good, better, best, never let it rest. Never let it rest till good gets better and better gets best. So I'm going to show you where IRAs and 401ks maybe used to be a good way to go, but not anymore, in my opinion. A Roth might be a better way, but the best way is neither IRAs or 401ks or a Roth. That's why I've never owned an IRA or 401k. I never will. And I've never owned a Roth IRA or 401k, and I never will, because why would I put up with those two inferior ways to save when there is a superior way? And I'm going to show it to you. But the problem is this: as a retirement planning specialist, people would come to me with their yet-to-be taxed IRAs and 401ks. And so many times they'd say, look, we have saved $1 million in these IRAs and 401ks. And they would be proud of this, which, yeah, they're savers. And they looked at it like this sumptuous Subway hoagie sandwich depicted here on the left. Before they would come to that first appointment, I would tell them, hey, I want you to bring me your after-tax IRA 401k statements. And they would go, after-tax? I don't think we have those. I knew they didn't. I said, well, let me calculate it when you get here. And then they would look at the after-tax statement that I created. It would look like this unappetizing sandwich on the right, because the government was going to swoop in and help themselves to about a third of that retirement sandwich or nest egg, whatever you want to call it. And so I would look at people and say, golly, you know, you've accumulated $1 million, but only about $650,000 of that is your money. If you think you could earn 10%, and that means you could pull out $100,000 a year, you're not going to net $100,000. You're going to have to pay taxes. 41 out of 50 states has a state income tax. You're going to be lucky to net $65,000 out of the $100,000. And then they would say, well, golly, because of inflation, I need a net of $100,000. I say, well, in a 33% bracket, how much more do you think you need to withdraw? And they would say, well, 33% more money. No. In a 33% tax bracket, you have to pull out 50% more. And they'd go, really? Oh, I don't understand that math. Okay. If you can get by on $100,000 net to buy gas and groceries, and you're going to have to pay tax in a 33% bracket, you have to pull out 50% more. You have to pull out $150,000, pay tax of a third, 50 to net 100, okay? You have to pull out 50% more money, and their nest egg is gone in 11 years. I'm going to prove it to you here in just a moment. So, I would say, man, were you planning your retirement or Uncle Sam's when they would come in? I have taught advanced continuing education to CPAs and tax attorneys for years, and they sit there with their mouths open and they go, wow, we always have heard about these tax-free vehicles, but we didn't understand them. I said, what have you been telling your clients to do? Well, what they don't know won't hurt them. We're just telling them to follow the herd and put money in tax deferred IRAs or 401ks. I said, well, at what point did you notice they were savers and they were not going to be in a lower tax bracket when they retired? Oh, well, we could tell that 20 years ago. Are you being a good fiduciary? Are you looking out for their best interest by allowing them to continue to defer, procrastinate, paying tax to some future perceived unknown advantage? And you can tell they're going to be in a higher tax bracket when they retire. Oh, wow, they got nervous. I would show them something far better. And so many times, even after they learned it, they were shy to go back and tell their clients, hey, you know what, I told you what I thought was the best at the time, but I've learned something better since. And I go, yeah, you need to do this. You need to say, I found something better since, because if you don't tell them, somebody else is. But so many accountants, once they would learn what was better than an IRA or 401k, they would go, Doug, we don't have time to educate people like you do. And so it's like, oh, did I tell you about the parachute when it's too late to safely not outlive your money in your golden years? Now, when we had the Great Recession from 2000 to 2012, from 2001 to 2003, after the 9/11 terrorist attacks, most Americans who accumulated $1 million, let's say, they saw that $1 million nest egg dwindle down from 2001 to 2003 down to 600 grand. It took 4 years till 2007 to make back what they lost. They felt like they had lost their future. They put off retirement 7 years. Now, our clients, using my favorite vehicle, I'll talk about in a moment, the laser fund, they actually doubled their $1 million to $2 million in that period when most Americans were barely back to break even, okay? But what happened is in 2008, when they finally thought they could retire, most Americans lost 40% again for a second time, and it took 4 more years until 2012 to make back what they lost. In the meantime, people who had the laser fund ended up with 2.5 to 3 million for the $1 million they started with, when most Americans weren't even barely back to break even again until the 12th year. That's how significant this is. And so this is why in 2009, after the second time the market dropped 40%, there was a front page story on Time magazine that said why it's time to retire the 401k and do something better instead. The author of that article was Stephen Gandel, and he said, yeah, the 401k is a rotten repository, a financial flop for our retirement reserves. Now, he was talking about why the 401k was never designed to really be in a volatile market, and people were losing money due to the market, and that's why many of the champions of the 401k in 2017 lamented the day they ever came up with the idea, because they didn't want it to become the predominant retirement vehicle. Well, it became that because then employers could get rid of the defined benefit pensions and let the people choose where they invested it, and then it was their problem if they outlived their money. Well, I said it's not just market volatility. It's because of taxes. Most people are not in lower tax brackets when they retire. And so that premise has been wrong for 30 years. People are not in lower tax brackets when they retire unless they didn't save very much. Do you want to be in a lower bracket because you didn't save very much? And so I've always said these two things are absolutely certain. Money will never be worth more than it is today. And your current tax bracket will likely be the lowest bracket you will ever be in. So if those two statements are true, what should you be doing? You shouldn't be deferring your retirement taxes to some future perceived unknown advantage. See, whenever I ask people, how many of you think the taxes in the future will likely be lower? I get nothing but crickets. How many think they're going to be the same? 1 or 2 hands goes up. Well, how many think they're going to be higher in the future? And a sea of hands goes up. And I go, well, why are you continuing to defer paying tax to the future when you know taxes are going to be higher? That doesn't make sense. But they are continuing to do that. They just follow the herd. And so if this premise is true, you ought to be doing something different. Well, also, taxes are higher because we kill our tax deductions. We pay off our house. The kids are gone. If they move back in as adults, you can't deduct them anymore. You're not contributing money to IRAs and 401ks, so you don't have those deductions anymore. If you're a business owner and you sold your business before retiring, you don't have those deductions anymore. And Congress, because of irresponsible government spending and the printing of money, taxes continue to go up. We saw this during COVID-19, where the government actually spent 3 times more than what they brought in. The government was bringing in about $3.5 trillion net in tax revenue, and they spent triple that during COVID-19 in the year 2020. Well, if you were making $100,000 a year and you spent $300,000 by borrowing or something's got to give. But instead of doing that, they continued to pass spending. And then how did they try to solve it? They printed money, which is a hidden tax. It hurts the little guy. And also they come up with tax increases. So that's why Joe Biden, he had to scramble because inflation was going crazy, because he started printing money faster than any previous administration in the history of the United States. You show me any country that tried to dig their way out of recessions and spending by printing money where it ever turned out good. It never has. And so then he wants to increase taxes, income taxes, reduce 401k tax benefits for higher income earners, dramatically increase capital gains tax by double. He wants to even do away with the step-up in basis on long-term capital gains. The estate tax, that's called the inheritance tax, he wants to increase by 50%, going from 40% up to 67%. Increase corporate tax from 21 to 28%. And, they go, oh, well, it's only 7% more. No, it isn't. That's 33% more. And people go, how do you figure? See, if a corporation is paying 21%, that means on every million of profit, they were paying $210,000 at that rate. Now they're paying $280,000. That's $70,000 more. $70,000 more is 33% more than they were paying at $210,000. See? And yet government revenuers go, well, they can afford it. Well, no, they can't. Most businesses, corporations operate on a 2 or 3% profit margin. So what do the corporations do? They change to automation. They let people go, and they don't expand. And so that causes unemployment. And then they raise the prices of goods and services, which causes inflation. It doesn't do any good to raise minimum wage to $15 an hour when that's all gobbled up at the gas pump and the grocery store or the hamburger stand. And then you have healthcare initiatives and student loan debt forgiveness, which is really, they're just trying to buy votes, but it's causing taxes to go through the roof. And who does it hurt the most? People who are on fixed incomes like retirees. So that's why it's one of the biggest dangers. And many times, tax deferred IRAs and 401ks, when you look at them, deferred taxes just really mean increased taxes because the government has a permanent tax lien. The more that you save and defer, the more they get on the back end. They're using you as their savings bond. It's the best savings bond they ever came up with for themselves, okay? So I've always recommended you accumulate your money tax-free and be able to turn on tax-free income. And I explain how to do that in my book, The Laser Fund. But let me show you why it's tax-free, because some people think, well, there's got to be a loophole or something. Well, there's 4 phases of retirement planning: the contribution phase, accumulation phase, distribution, and transfer phase. And I go through and look at 5 different categories or ways that people save. Well, sadly, the worst way to save is the most common way Americans save. They put money in banks and credit unions and regular mutual funds. They're taking after-tax dollars and they're investing in it, and then they pay tax every single year on the interest and dividends. They pay taxes on the gains every time they realize a gain, and it's taxed when they die and they transfer it. Tax, 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 4 red circles. Worst way to save, and I'm going to show you mathematically how bad that is. Now, there's another popular one where people say, well, I'm going to take after-tax money and I'm going to put it into a tax-deferred annuity or something. Okay, they get 1 green circle, but then when they start to turn on income out of the annuity, it's now taxable LIFO, last in, first out. All the interest, you put in $500,000, and if it was earning 10%, that's $50,000 a year. You have to pay tax on the $50,000 a year because that's the last money you're earning is the interest of the first money coming out. That is the one green circle method. Now, let me show you the numbers here. If you take $1 and you double $1 20 times, okay, 2, 4, 8, 16, 32, 64, 120, it'll grow to 1,048,000 if it's tax-free or tax deferred. Now, the way I just showed you, tax earned, let's say you're in a 25% tax bracket. $1 doubles to $2 and you pay tax of 25 cents and you got $1.75, that doubles to $3.50. You pay tax on that, you're only going to have 72 grand instead of $1 million. That's the most common way Americans save. Or in a 33% bracket, you'd only have 2.7% of $1 million, 27,000. That's the way most Americans save. Well, that's why people, they hear me talk about, okay, if you were a farmer and you had the choice of buying your seed in the springtime that you're going to plant, and you don't have to pay tax on the price of the seed. But you plant it, you cultivate it, you irrigate it, and later in the fall, during your harvest, now you agree to pay tax on what you sell your harvest for. That's a traditional IRA or 401k. You get a tax break on the seed money, but you agree to pay tax when you go to harvest your money. Now, that's because people are told you'll likely be in a lower bracket. Well, that has not been true, and so that's not a smart way to go. So when we look at traditional IRAs or 401ks, you get a tax break on the seed. It accumulates tax deferred, but when you go to harvest, now it's taxed, and then it's taxed when you die. If you believe taxes are going up, that's not the best way to go. So in 1997, because Congress was hard up for money, they passed the Roth. Senator Roth said, hey, people are getting smart. They realize they're not going to be in a lower tax bracket. You can name it after me. We need some tax revenue. They didn't do it for you. They did it for them. We'll get a tax revenue windfall instead of waiting for people to retire to slowly tax them on their withdrawals out of their IRAs or 401ks. Let's get it all in one fell swoop. It worked. People took and paid the tax on the seed, and then it accumulated tax-free, and it turned on tax-free income. That's a Roth. Now, I mentioned I've never owned an IRA or 401k, never will, but I've never owned a Roth. Why? Because Roths only have these two advantages. My favorite vehicle, an MFTA, Max Funded Tax Advantage 101A Alternative, has those two and an additional one. Anything I leave behind when I die blossoms, increases in value, and transfers income tax-free. I have flexibility. If you make too much money, you can't participate in a Roth. You can't set up a Roth to accommodate $30,000 or $300,000 or $1 million of annual contributions. You can with a max-funded tax advantage insurance contract. If it's structured correctly, it's called a laser fund. I'll show you how you can learn about this in just a moment. But this gives you gives you 3 green circles and the opportunity to then have 4 green circles. Okay, now this 3 green circles will give you double and sometimes even triple the net spendable income that 2 green circles does. It knocks the socks off of these. But I sort of like to have my cake and eat it too. I like to have 4 green circles. So as a tax strategist, I have methods whereby I can get indirect deductions that are very similar to getting a deduction on an IRA or 401k, but no, I don't do it at the expense of 2 red circles on the back end. I keep the green circles, and I have 4 green circles, and now I will sometimes have 4 to 5 times the income. I will not outlive my money from the same identical nest egg that people with IRAs or 401ks are outliving their money. So let me show you the math behind why this is like, this is poor, and this is fair, and this is good, better, best. I'd recommend the best. So let's say you look at these and you go, well, I put my money in a tax-deferred IRA or 401k. I have $1 million nest egg, just like you do, Doug. What's the diff? The difference is this. You don't choose investments based upon which ones grow the most. You choose them based upon which ones generate the most. At the time in life, you're going to need the money the most, at retirement. So what do they do during the golden years? This one's tax-free. This one now is taxable. So, and the way that most Americans save, tax as earned, if you needed a net of $100,000 to buy gas and groceries, prescriptions, and golf green fees after taxes and everything like that, you'll be out of money the very first year of retirement. If people had $1,048,000 in IRAs or 401ks and they needed a net of $100,000 to spend, in a 33% tax bracket, they have to pull out 50% more, $150,000, pay tax of a third, 50 to net 100. Your $1 million nest egg in your IRAs or 401ks will be gone, drained dry in 11 years. At age 76, you're relying on Social Security, charity, welfare, or your children for support, okay? You're dependent. With the same $1 million in a laser fund, you pull out 100 grand, you net 100 grand. It's tax-free. Your account is not depleting. In fact, it's growing ahead of inflation. It always has if you structure it correctly. So that if you or your spouse makes it another 20 years to age 96, you still have your $1 million, and you had another 20 years of $100,000 of income. That's $2 million, plus you still have your $1 million. That's a $3 million better retirement strategy than the same amount of money in an IRA or 401k. Hello? Would you like to have a $3 million better retirement strategy? Yeah. Well, then you need to study my book here. So let me put all this together. Ever since 1986 tax reform, President Reagan's second term, there are only 3 types of income that Americans pay income tax on, and it shows up on the front page of your 1040 tax return. Earned income, which would be your salaries and wages, passive income, which might be rental or lease income, and then portfolio income, which is like interest and dividends, and this is where most IRAs or 401ks fall, but they're all subject to tax, okay? Now, my favorite vehicle, the laser fund, has been a sacred tax-free cash cow in the Internal Revenue Code for 108 years. Under Section 72E, 7702, and 101A, they're explained in other episodes on this channel and in my book that I want to gift you. But when people just say, well, why is the laser fund tax-free? I'll just cut to the chase, because if I have $1 million in a laser fund, it can generate $100,000 a year of tax-free income from age 65 to age 120 without depleting principal. And people say, why is it tax-free? Because it's not deemed earned passive or portfolio income. The IRS knows that you're receiving it, but they know it's not even worth auditing because it's always been tax-free for over a century, okay? Now, there's 4 different resources or buckets of money that Americans may draw up to from. Not everybody does it from all 4, but investment income or real estate income, guaranteed income like Social Security or a pension if you're a school teacher, and then the tax-free income. This is the most underutilized. This is where I specialized. Now, the investment income would be yet to be taxed IRAs or 401ks invested in the market. Way too many Americans have 80, 90% of their retirement. They're way too top heavy in that purple bucket, especially at retirement. At retirement planning should be totally different than what you did for retirement. There's something you should do starting at least 5 years before you retire. I'm going to show you in just a second. Some people have real estate income, and I say, oh, don't rely so much on that. What if the real estate goes down in value? What if you have vacancies? You don't want to have all of your retirement income relying upon that one. Some people, based on their risk tolerance, they maybe go, well, Social Security or my pension is what, okay. But I would still recommend that you have at least 40 to 60% of your retirement income not even show up on the front page of your 1040 tax return. So what does that necessitate? For most Americans, you need to reposition assets. And you can do that by maybe liquidating some of your real estate if you're too top heavy here, or doing something here. But a lot of Americans, it requires what I call a strategic rollout, not a rollover. That's going from the frying pan to the fire. That's taking money out of a 401k, rolling it over to an IRA and continuing to defer until age 72, and then taking RMDs, required minimum distributions. If you do that, I can prove to you mathematically, you will pay taxes through the nose the rest of your lifetimes, and then your children have to pay tax when they inherit that IRA or 401k within 10 years after you pass away. Oh, it's horrible. People, when I add it all up, the taxes are astronomical. Get the taxes over and done with, do a strategic rollout, take the net after-tax money and put it into something that's going to be tax-free from now on, a laser fund. You'll learn that a laser fund knocks the socks off of Roths and municipal bonds because laser funds have 6 major advantages. Roths only have 2. And so, and this is my favorite vehicle. I would recommend that no more than 30% of your income be in that purple bucket, IRAs or 401ks at retirement. Wall Street was not designed to create predictable cash flow. I'd recommend if you have a lot of rental income real estate, no more than your retirement income should be reliant on that. I'd recommend that between 0 to 80% ought to come from the guaranteed bucket, but 40 to 60% ought to come from the tax-free bucket. Now, that's my recommendation. I've actually had some clients in California. They were in the highest tax bracket, and after 5 years of doing a strategic rollout, they're now in a 0% tax bracket. The government loved them for 5 years because they got a ton of tax revenue. They had $6 million up here, and they ended up with $4 million transferred down here after paying $2 million in tax. That $4 million doubled in 7.5 years to $8 million. They now have $8 million tax-free. Do you know they don't even have to file a tax return? Because if you have income that is not deemed earned passive or portfolio income, there's nowhere on a tax return to put it. You don't even need to file a tax return, okay? The IRS knows they're receiving this. They only need $300,000 a year to live on, but they're earning over $800,000 a year on that $8 million. Would you like to be like them? Well, then you need to study my book, The Laser Fund. And so this is a 300-page book, which is actually 2 books in one. This side is about 200 pages, 14 chapters with all kinds of charts and graphs and explanations for the left brain learner. For the right brain learner, you learn by stories and examples. You flip it over and read this one. This is about 100 pages, 12 chapters with 62 actual client stories of how a properly structured IUL, a laser fund, is the dream solution for all kinds of financial goals. If you want to use your whole brain, read both of these books, okay? But you simply go to laserfund.com or click on the link below, contribute a nominal amount towards the shipping and handling. I'll cover the rest of that, and I'll pay for the book. It retails for $20 on Amazon. If you go there and buy it, thank you. But I'll pay for the book. I'll fire out a hard copy to you via priority mail, but when you're in there claiming your free copy, if you like to listen and learn or watch and learn, there's options there for that. You can register for free educational webinars we do on a regular basis, but you could even schedule an appointment with a certified IUL professional with no cost or obligation to see how these strategies may apply in your particular set of circumstances, because if you want to move ahead and double, triple, or quadruple your net spendable income, make sure it is done correctly. This book will show you the criteria to do that. So this is not about me. This is about you and your brighter future.